Today in this video, we are going to talk about the institutional ways of trading and their strategies. Let's get straight to the strategy. Please ensure to like, subscribe and press the bell icon for upcoming strategies on this channel. You need to know the importance of the institutional players, who they are, and their impact on the day-to-day price movement. Trading securities can be as simple as pressing the buy or sell button on an electronic trading account. More sophisticated traders, however, may opt for more complex trades by setting a limit price on a block trade that is parsed over many brokers and traded over several days. The differences lie in the type of trader, and there are two basic types: retail and institutional. Retail traders, often referred to as individual traders, buy or sell securities for personal accounts. Institutional traders buy and sell securities for accounts they manage for a group or institution. Pension funds, mutual fund families, insurance companies, and exchange-traded funds, ETFs, are common institutional traders. Several of the advantages institutional traders once enjoyed over retail investors have dissipated. The accessibility of sophisticated online brokerages, the ability to trade in and receive more diverse securities, such as options, real-time data, and the widespread availability of investment data and analysis have narrowed the gap. Institutions makes use of long-term EMAs, exponential moving average. 300 and 365 are the best-known EMAs used by institutions. First, we will talk about why EMAs and how the institutions use these EMAs in their day-to-day trading strategies. Highlighting and identifying price trends are one of the most important functions of an EMA. A rising EMA indicates that prices are on an upward trend and vice versa. When the price is above the EMA line, it is likely to rise, and when it is below, it's likely to fall. Another way to use exponential moving averages is to use them as dynamic support and resistance levels. We like to call it dynamic because it's not like your traditional horizontal support and resistance lines. They are constantly changing depending on recent price action. There are many forex traders out there who look at these exponential moving averages as key support or resistance. These traders will buy when the price dips and tests the moving average, or sell if the price rises and touches the moving average. Trading ranges expand in volatile markets and contract in trendless markets. In both cases, moving averages will show similar characteristics that advise caution with day trading positions. Hence, selecting the right EMAs help you filter these noises and you can enter in the right direction when clubbed with price action. An exponential moving average strategy, or EMA strategy, is used to identify the predominant trend in the market, but still treated to be a lagging indicator in nature, as this calculates data based on the history and projects the future price. Currently, this is how most of the traders make use of the EMAs in their trading style. Above the EMAs is considered to be an uptrending market and they look for a good buying opportunity. Below the EMAs is considered to be a downtrending market and they look for a good selling opportunity. EMAs acting like dynamic support near the average line, creating opportunities to buy. EMAs acting like dynamic resistance near the average line, creating opportunities to sell. Here is a candle chart with exponential moving average plotted. So, what's next? Retailers build their strategies by considering anything above the average is a buying opportunity and anything below the average is good for selling opportunity. This means you try to buy when the price hovers around the average but it is above the EMAs, and vice versa, where you look for shorting opportunities when it's just below the EMAs line. But do you really know what's happening there? It's a range-bound, or you call it either an accumulation phase or distribution phase, where real-time big players are entering their trades by executing large positions in bits and pieces. Hence, the market is range-bound, and the price will only show movement once institutional players have completed all their orders. So, what did you understand from this? EMAs is good when the market is trending. You can use it as a support and resistance. But how do you really get to know that the market has really taken either the support or resistance? I agree, no one will be able to. Not even me. The reason is, we are retail traders and normally have short-term or medium-term EMAs plotted on our chart. So sometimes, we get the right trade in the right direction or the stop-loss gets hit. So, what do we do here? Let us start thinking like an institution player. We will make use of long-term EMAs and wait for the market to give us the direction. This is where the Dow theory comes into the picture. So, what is Dow theory? Dow theory suggests the markets are made up of 4 distinct phases, which are self-repeating. These are called the accumulation phase, the markup phase, the distribution phase, and the markdown phase. The accumulation phase usually occurs right after a steep sell-off in the market. When the stock price languishes at low levels. This is when the smart money enters the market. Smart money is usually the institutional investors who invest and seek value investments that are available after a steep sell-off. They start to acquire shares regularly, in large quantities over an extended period of time. Hence invariably, the accumulation phase marks the bottom of the markets. Once the institutional investors absorb all the available stocks, short-term traders sense the support. This usually coincides with the improved business sentiment. These factors tend to take the stock price higher. This is called the markup phase. During the markup phase, the stock price rallies quickly and sharply. The most important feature of the markup phase is speed. Because the rally is quick, the public at large is left out of the rally. New investors are mesmerized by the return, and everyone from the analysts to the public sees higher levels ahead. Finally, when the stock price reaches new highs, everyone around would be talking about the stock market. The news reports turn optimistic, the business environment suddenly appears vibrant, and everyone, public, wants to invest in the markets. This is when the distribution phase occurs. Institutions will start offloading their shares slowly. The public will absorb all the volumes offloaded by the institutional investors, smart money, thereby giving them the well-needed price support. The distribution phase has similar price properties as that of the accumulation phase. Whenever the prices attempt to go higher in the distribution phase, the smart money offloads their holdings. Over a period of time, this action repeats several times, and thus the resistance level is created. Finally, when the institutional investors, smart money, completely sell off their holdings, there would be no further support for prices. Hence, what follows is the markdown phase. Let us see how this distribution phase appears on the price chart. Here you see an example. The price had been consolidated for some time, and once all their orders were executed there was a markdown and a sharp fall in the price. I hope you have started relating it to the Dow theory we just learned. Let us see how this accumulation phase appears on the price chart. Here you see an example. The price had been consolidated for some time, and once all their orders were executed there was a markup followed by a quick sharp rally. Now we simply bring in our long-term EMAs that we discussed. This will ease your price reading and help you make positions better in your trade plan. Let's plot both long-term EMAs 300 and 365 respectively on the chart and see the difference in the price reading. This is another example of the accumulation phase after plotting the long-term EMAs. Now you will see that we are really finding a spot to make positions. I will now explain how to plan our trades with the help of these EMAs and the Dow theory. This is a USD, JPY chart where you can see how the price was consolidating. We have plotted the long-term EMAs to read the price movement better. Now you will observe as soon as the price started coming down the EMAs, there was a sharp downfall. Now how to position the entries. As soon as the price breaches the long-term EMAs and has also given a range breakout, that candle is your markdown candle. You can immediately enter on the low of the markup candle and keep the stop loss just above the high of the markdown candle. This way you can trail every swing and make the best profit. Now if you club this with price action, you will notice that there was a decent trendline break which has double confirmed your entry. Here, you see another example of the USD CAD chart formed a distribution phase and gave a sharp rally. So as per the strategy, you will wait for the price to close below the EMAs and confirm you with the markdown candle. As soon as you see the markdown candle, you will place your short entry below the markdown candle and subsequently place your stop loss just above the high of the markdown candle. If you club this with price action, you will observe a double top formation breakout. This way you will successfully trail and make huge profits from this strategy. Here, you see another example of the EUR JPY chart formed a distribution phase and gave a sharp rally. So as per the strategy, you will wait for the price to close below the EMAs and confirm you with the markdown candle. As soon as you see the markdown candle, you will place your short entry below the markdown candle and subsequently place your stop loss just above the high of the markdown candle. Now, let us see few examples of the accumulation phases and how the markup candle gives us the entry to go for long opportunities. Here, you see an example of the USD CAN chart. The price was range-bound and consolidating for a longer duration. This is the accumulation phase. Once the range breakout was given, we waited for the markup candle formation above our long-term EMAs. As soon as the high of the markup candle was taken out, we enter the trade. Slightly below the markup will be our subsequent stop loss. And now you see how the price had given a sharp rally. If we club this with our price action, we would have observed that there was a decent trendline breakout as well on this trade. This double confirms our strategy and the buy position. Here, you see an example of the EUR/USD chart. The price was range-bound and consolidating for a longer duration. This is the accumulation phase. Once the range breakout was given, we waited for the markup candle formation above our long-term EMAs. As soon as the high of the markup candle was taken out, we enter the trade. Slightly below the markup will be our subsequent stop loss. And now you see how the price had given a sharp rally. If we club this with our price action, we would have observed that there was a double bottom formation as well on this trade. This double confirms our strategy and the buy position. Here, you see an example of the EUR/JPY chart. The price was range-bound and consolidating for a longer duration. This is the accumulation phase. Once the range breakout was given, we waited for the markup candle formation above our long-term EMAs. As soon as the high of the markup candle was taken out, we enter the trade. Slightly below the markup will be our subsequent stop loss. And now you see how the price had given a sharp rally. If we club this with our price action, we would have observed that there was a double bottom formation as well on this trade. This double confirms our strategy and the buy position. Few key takeaways from this learning. Please ensure that you go through the video multiple times, especially the Dow theory concept, so that you start understanding the different phases of the market. This will help you plan the right trade, and trade with great discipline. Long-term EMAs has a great impact on the price movements. This is being closely watched by the big player who drives the markets. So I recommend you to do some chart studies by plotting these EMAs and see the price moves. This strategy works well when clubbed with price action or chart breakout patterns that form a consolidation. Now when you see the chart, you will start understanding the reasons behind this type of consolidation. This strategy has a great success-winning ratio. We have tested this on more than 100 different charts and the accuracy is the best. You can apply this strategy on any chart and this can be used in any time frame. I hope this strategy is going to help you in all your upcoming trades. It's a powerful strategy. Kindly do some backtesting to gain confidence in this strategy and we wish you all the best for your trades. Thank you.